Welcome to L'Oréal's Valuation Project. In this session, you will learn how me and my colleagues value the company using the discounted cash flow and multiples method. I'm Sharmeen and my colleagues are Sofia and Anna. I'd like to start with a simple background for L'Oréal. It is a French-based holding company. They have many subsidiaries that manage the operations of the L'Oréal Group in the regions it is located globally. The four cosmetic divisions are Professional Products, Consumer Products, L'Oréal Luxe, and Active Cosmetics. With over 826,000 employees spread over 150 countries with 34 brands and 498 patents, the company has made sales of 26.02 billion euros alongside an operational profit of 4.68 billion euros. Before starting the main valuation, we studied a little over the last 3 years' performance of the balance sheet and the profit and loss statements. And what we gathered was that an increase in intangible assets in 2016 was recorded to be higher than 2015 and 2017, which resulted in total assets of the company to be higher in 2016. Then a steady increase of 5% in total equity was recorded over the years 2015 to 2017, and of course there was also an increase recorded in 2016 due to higher number of other current liabilities and income taxes. As for the profit and loss statement, we can say sales, gross margin, and EBITDA have increased over the years and recorded a gross profit increase of 40 basis points. Net income decreased in 2016 due to an increase in the depreciation and amortization in 2016, after which the increase was recorded to be around 15%. Moving on to the cost of capital. In order to calculate the value of WACC for L'Oréal, we had to compute the cost of equity and the cost of debt. For the cost of equity, we used the basic CAPM formula, for which we extracted the risk-free rate from the long-term treasury bonds yield to maturity for the most important geographical zones. And we also used a 5-year monthly levered beta that was hauled from ICANN, and then we used the formula to get the unlevered beta for the calculation. The tax rate that we use is marginal, and it gives us a cost of equity of 7.32%. As for the cost of debt, we used the spread and the risk-free rate to obtain the value of 4.2%, and then subtracted the tax rate mentioned earlier to attain the cost of debt of 3.15%. Hence, the WACC for L'Oréal is 7.27%. For the chosen peers of L'Oréal, similar information was used since we are comparing their performance alongside L'Oréal's, except for the beta, for which we use the average of the betas retrieved from Thomson Reuters. So the results obtained for the cost of equity and the cost of debt are as shown. Hence, the WACC for L'Oréal's peers is 6.68%.
Let's now talk about the forecasted business plan. According to our assumptions, sales are growing between 4 and 5% per year. The increase in sales is mainly due to the growth in new markets. Cost of goods sold are also increasing in the future. More sales imply more costs. However, the percentage of cost of goods sold in terms of sales remains similar to the last 3 years. The same reasoning applies to the OPEX costs. Due to the increase in sales, EBITDA will also increase with a margin between 20 and 21%, as well as the EBIT. EBIT margin is nevertheless lower due to the increase in amortization and depreciation costs. As the company grows, so does the CAPEX. Net working capital will also increase in the future. Let's now see the main assumptions of our business plan. On one hand, performance is expected to remain solid for more mature markets, so we expect sales growth to be equal to inflation rate for these countries. On the other hand, new markets show considerable growth potential. In many countries, the consumption of cosmetic products per inhabitant is 10 to 20 times lower than in mature countries, so we expect sales growth to be equal to these countries' inflation rate plus GDP growth. Although costs of goods sold are increasing due to the increase in sales, L'Oréal has been the worldwide beauty leader for many years, and thus no significant changes are expected. For OPEX predictions, we believe L'Oréal will continue to invest in trends and technology. Therefore, research and development expenses will keep increasing as revenues do and in the same percentage as they did before. The same will occur with advertising and promotion expenses that are essential for L'Oréal to inspire trust. For reasons relating to strategy and competition, L'Oréal cannot provide systematic information on future investments. However, improving industrial efficiency, research, digital development performance, and enhancing brand value are priorities to L'Oréal that will continue to be accomplished by increasing capital expenditures. For net working capital, historical data seems to be a fair indicator to predict the future, so it is expected to remain in the same percentage of the key indicators as it did before.
When computing the free cash flow to the firm, the cost of capital is the estimated WACC previously mentioned of 7.27%, and the growth rate in perpetuity is assumed to be the weighted average of the GDPs of geographical areas in which L'Oréal operates, which is 2.6%. Our DCF valuation estimates an enterprise value of 77.3 billion euros. After adding the net cash and other non-operational assets, we reach an equity value of 87.2 billion euros and a price per share of 154 euros and 66 cents. Our share price is low compared to L'Oréal's current share price as well as the price at the end of 2017, and so our recommendation is short selling the L'Oréal stock. We performed a sensitivity analysis to determine the impact that different operational assumptions would have on stock price. We also tested the sensitivity of the price to different combinations of cost of capital and growth rate in perpetuity. Regarding the multiple valuation using comparable companies, we decided to exclude Coty from our previously selected peer group, as we consider it to be an outlier with all multiples well below the rest of the group. For the valuation, we take the average of each multiple of the remaining peers and compute an estimated enterprise value and price per share according to each multiple and to the financial indicator of our target company. The range of the estimated price is between 201.95 euros and 209.15 euros per share. The multiples valuation results in a much higher value than the DCF valuation, and there can be several reasons for this. We have to remember, multiples approach is only a simplification, and we know that no peer company will ever be a perfect match to compare with the target company. As we mentioned before, the estimated share price we got from the DCF valuation is much lower than the L'Oréal current share price. This can be a result of several factors, namely the assumptions used and the limited amount of information released. However, we believe that we made reasonable forecasts that take into account both the historic values and the growth prospects for the future. For this reason, our final recommendation is to short sell L'Oréal stock. The price we got from the multiples valuation is actually similar to the share price at the moment. However, it is much higher than the one we got from the DCF valuation. Taking into consideration that DCF is the most accurate way to perform a valuation, some questions arise at the possibility of the overvaluation of the whole beauty market.
With this conclusion, we have now reached the end of our valuation. We hope you enjoyed learning a little about L'Oréal. Thank you for your attention.